So first of all, thanks all of you for joining us. I know everyone is busy, and I really appreciate your time and you joining us. I'm going to get right into it. But before I begin our official presentation, there's one piece I just want to touch on that's kind of interesting. I occasionally get asked, how are things at Canaccord? How is it since the move, et cetera, et cetera. And it was interesting last week on Thursday, something happened that I think kind of epitomized the move. Basically, the head of data and analytics for the entire company, first of all, he requested if he could meet with us, which of course we were happy to. Anytime you have the head of any department, you're always going to want to meet with them. So he came in and he said, first of all, I want to congratulate you guys. We basically really like what you're doing. We really wanted to recognize your practice and tell you you're doing a great job. I then asked him how they quantify that in terms of great job. What does that mean? And he basically said everything from investment performance to what basically they call, in a way, client satisfaction. What he meant by that is that we, by and large, are managing all the money for all our clients, which is a sign of success. And how they gauge that is we look typically for all clients, we have their RRSP or RIF, we have their tax-free savings account, we have their cash account, all those different pieces. Now, that's not as important as the next piece. Basically, he talked to us about enhancements they're going to make to technology within the company, which is one of the reasons we came here. They're always giving us top-notch equipment, whether it's for analyzing the portfolios that you hold, being able to communicate with you, all those different pieces. And he outlined a number of things they were doing. And then he asked us, he said, how can we better help you? And he asked us to talk about our workday, how we do our work, how we communicate with our clients, and basically, again, asked us what they could do to help us. And he took some notes, and the key there being that they listen to us and they're willing to do whatever which is in essence you need. What we need is basically what you need. What you've requested is what we want to see. So I was really happy to see that. Not going to get into the past, but a much different environment here, and that was great. So I'm going to begin get right into our presentation, Certain Uncertainty. We're going to be touching on some tough topics. We've had a big increase in interest rates. We've all seen high inflation potentially coming down, but we've seen some crazy prices at grocery stores. We've seen anybody that has a loan has seen some shocking changes in the payments, or will see some shocking changes in the payments. Talk of potential recession, so some tough topics. I do want to start off something. We have some good news. For the first time in quite some time, we have the Vancouver Canucks, the Edmonton Oilers, Toronto Maple Leafs, all undefeated, all tied for first place. So I wanted to announce we do have some good news there, and so we're looking good there. Going back to our topic, as I mentioned, we have seen some extreme changes. Interest rates, depending how you want to measure it, they've doubled, they've tripled, they've gone up over 2,000%, depends how you want to measure it, but big changes in interest rates, big changes in inflation. One of the reasons our uncertainty is because with everything that's going on, the top strategists today, in my opinion, the smartest people are not saying we're going to have a soft landing, we've beaten inflation, it's going to start to come down, et cetera, et cetera. In my opinion, the top people today are saying we've had some big changes. Some big changes have been enacted, and we really need to wait and see a clear direction. And so that's one piece I really wanted to touch on, is that you do need to wait and see the clear direction. On that note, with everything going on, what have we done? All the changes in interest rates, inflation, all these things, what have we done? So we've done nothing. We've just basically sat there and left things how they've been. Okay, obviously that's not true. I was hoping we would get some eyebrows raised. We've been actually taking a lot of action. We are looking at the different paths that inflation, which way it's moving, these sorts of things. But we've been taking a lot of action. We've moved more defensively. We now have some money parked in short-term fixed income, money market, overnight banknotes, that sort of thing. They're paying almost 6%. That allows us to be nimble. That allows us to take advantage if stock or bond prices were to drop. We've also locked in some decent rates, over 5%, again, closer to 6%, GICs, bonds. So we've done some things to make the outcome more certain. We've added some, some decent yields, some different or some decent investment returns kind of guaranteed, built in. And we have been very active, very proactive. It became apparent quite some time ago that, inflation was a big problem, that central banks were going to raise rates. We've taken, as I say, action on that, and I'm going to turn it over to Chris to articulate a little bit more of what's going on and what we've been doing.
Perfect.
Sorry, Chris, I just wanted to also say the idea of this is it is a meeting, not a presentation. So please, we want to have interactive. At any time, feel free to ask questions. And that could be just plain speaking, and the microphone will go over to you. That could be via the reactions, raising your hand. That could be typing into text a question, but the key is we do want it interactive. This is your meeting, and we want to, basically for you, we want to address your questions. So sorry, over to you, Chris.
Perfect. Thank I'm going to quickly share my screen here. All right. So hopefully everyone can see that. We good? Perfect. So just as a reminder, this webinar is being recorded. Like Leon said, it's pretty informal, so feel free to ask any questions as we go. I'll be pausing at certain points along the way to ask for questions. So please don't be shy. If you're thinking of it, most likely someone else is as well. So I encourage you to participate and just go ahead and ask your questions. So certain uncertainty, we went with this title because obviously currently there are lots of unknowns in the market right now. For example, are we going to recession? Will the Fed be able to orchestrate a soft landing? Which way is inflation going? Are central banks done raising rates? Hopefully we'll give you some insights into some of these questions here. Before we start off though, let's quickly define an economic soft landing. So basically, this is a scenario whereby central banks can raise interest rates just enough to tame inflation without tipping the economy into a recession. So a little quick history. In 1994, the Federal Reserve, chaired by Alan Greenspan, actually engineered an economic soft landing for the US economy. Although some researchers argue that the Fed may have done this at other points in time in history, 1994 is the only time where all economists unanimously agree that a soft landing was achieved. So the point being here is that soft landings are elusive and they're very, very difficult to orchestrate. It's like threading a needle. So how do central banks fight inflation? In order to slow inflation, central banks raise interest rates to restrict the economy. So with this slide, we can see central bank interest rates for all the major central banks. In Canada, we're the red line. The Federal Reserve is in purple. So central banks started raising rates in March of 2022, around this point here. That being said, rates did not become restrictive to the economy until interest rates hit about 2.5% around this level here. So what do I mean by that? Because interest rates were artificially low at zero, raising rates from 0 to 2.5% really didn't really affect the economy because there were still good bargains to be had. Cost of capital of 2.5%, you could still borrow money to invest, do a reno, buy property, and still make a decent return. Obviously, with interest rates now around 5%, the economic hurdle rate is much higher, which means that the opportunities are much more limited. So let's examine how the interest rate effects are impacting the economy. The answer is that it happens with a lag. So initially, when interest rates rise, not everyone is immediately affected. At first, only new and variable rate borrowers are impacted. For fixed rate borrowers or bond issuers, it takes time until these mortgages to come due and reset at the higher rate. So historically, this lag effect usually takes between 6 to 18 months. So if you look at our current economic cycle, interest rates didn't become restrictive until about October 2022. Well, if you fast forward 1 year to this October, almost right on schedule, we're starting to see the impacts of higher interest rates on the economy. As Milton Friedman once said about monetary policy, it's a blunt instrument that operates with a long and variable lag, and we're about to see the effects of those lags. At this point, I just wanted to see if anyone had any questions at all. No, okay, I think we're good. All right, so this slide here shows the Canadian economy. As you can see, over the last couple of quarters, the Canadian GDP has slowed quite dramatically. Last quarter, we came in at 1.12%. So clearly seeing the impacts of the higher interest rates. The Eurozone economy is very similar, almost the same trend. The only difference is that they had a much stronger recovery out of the pandemic, but their economic slowdown has been much stronger as well. Where things kind of deviate and bucking the trend has been the US economy, which has seen strength over the last couple of quarters. So this is where you hear the story of an economic soft landing, is basically these data points that are driving that story. So where is that strength coming from? Well, back in August of last year, the Biden administration passed the Inflation Reduction Act, and essentially it contained about $500 billion in new spending and tax breaks. So we are seeing that fiscal stimulus in the markets as we speak, counteracting the effects of higher interest rates. All right, so where's inflation now? Before we get into that, I thought it'd be useful to remind ourselves where inflation comes from. In this chart, we can see that central bank monetary response to the COVID pandemic led to a significant increase in the money supply. You can see how active the Bank of Canada was, which is in red. The spike there just shows they were the most aggressive central bank during the pandemic. So the impact on inflation. Here we show the inflation rate for the same major economic zones. Again, Canada is the red line. So this is the inflation rates. A couple of things to note. The Eurozone, which is in green, experienced the highest inflation, which makes sense because of the geopolitical issues around their energy dependence and what we saw happen with Russia. For me, the most interesting country was Japan, which is in yellow, which is experiencing inflation after decades of deflation. So things are certainly changing. At home in Canada, we can see that inflation rates peaked at 8.1% in July in 2022. While it's come down from its high, you can notice that over the last couple of months, it's starting to bounce back up to about 4%, most recently in July. Most importantly, it's still well above the Bank of Canada's 2% target rate. In the US, they're showing the exact same trend. Now, their inflation peaked at 9.1%, also in July of 2022. And it has rebounded as well over the last couple of months, but well above the Fed's 2% target rate. So this kind of begs the question, why is inflation bouncing back up? So the key trends that we're seeing right now are the effects of wages, rents, and energy prices. So this is a pretty complicated chart, but let's see if we can take some time to walk through it. Here we see wage inflations in light blue against US inflation, which is the black line. So two things that's very important to note. At this point here, when inflation goes above 5%, you can see that wages really start to accelerate. What I also want to show is that over the last 8 months, the growth in wages has exceeded that of the inflation rate. So this is problematic because labor costs filter back into the inflation numbers with a lag. creating a feedback loop where higher inflation leads to higher wage demands, which feed back into higher inflation, and the cycle continues. So this chart here, we're showing US rent inflation. So although it's coming down, meaning that rent prices are not going up as fast, but they're still going up, but at a slower rate. This rate is still above the 2% target for the Federal Reserve by quite a significant margin. So we still need to see US rents come down for overall inflation to come down in the US. The last piece is energy inflation. So here we specifically are looking at US energy inflation. You can see how it's come down since the middle of 2022. Now, the effect that this had helped to drag inflation down in both Canada and the US. However, the last couple of months, it's bottomed and now energy prices are starting to rise again. If the recent strength in oil persists, energy prices will stop pulling down inflation and could lead to stronger inflation numbers in the future. So where does that leave us? Interest rates going forward. Well, while inflation has come down from its peak, again, we're starting to see it reaccelerate. We expect that central banks will keep interest rates high until they are confident that inflation is contained well below 3%. So this should keep interest rates at current levels or potentially higher for both the US and the Canadian economy. So how does it affect us? Well, first of all, this is great for bonds and it's great for savers. The era of of financial repression is over now that we have attractive alternatives to stocks. So for the first time in over a decade, we're getting a real return on bonds, and that's a return over and above inflation. So about 3 years ago, when inflation was around 3%, and GICs were yielding less than 2%, you were actually losing about 1% or more to inflation. Today, with yields around 5.5% to 6.5% on short and medium-term bonds and inflation around 4%, you're actually getting a real yield of 1.5% to 2%, which means savers, by just saving money, you're actually beating inflation by just saving money. In money market rates, that are currently between 5 and 5.5% risk-free. And so to put this into perspective, this is about 1/2 to 2/3 the long-term return of the stock market, but without the risks. So from an investor's perspective, this really changes the calculus in terms of asset allocation. So what about the equity markets? Well, stock prices, right now stocks are expensive in our view. Recall the prior slide where central banks were printing money and increased the money supply and how they pumped cash into the economy during the pandemic. Well, a lot of these increases in the money supply found its way into the stock market in the form of savings. Based on current valuations, we believe the market is pricing in a soft landing for the economy. While we certainly welcome that outcome, we think it's a little bit too optimistic in our view. So this chart shows the money supply of the US in blue against the S&P 500, which is the green line. And you can clearly see the relationship between the two. In our last webinar, we discussed the importance and the important role that stocks play in protecting against inflation. Well, this chart hopefully supports that thesis. Finally, this chart shows the valuation of the S&P 500. Now, without getting into things too technically, essentially the dotted line in the middle here shows the historic average of 20 times earnings going back to 1950. So the way to think about this is the further away you get above the line, it means that stocks are getting more expensive. The further away you get below the line, stocks are becoming more cheap. So you can see that stocks are clearly expensive on a historical basis. Equity valuations haven't been this high since the dot-com bubble, the 2000s. And this is why we believe that the market is pricing in an economic soft landing, which we think is a little too optimistic. So before I go any further, I just wanted to take a pause. Do we have any questions from anybody at the moment? Nope, we're all good. Okay.
Chris,
Yes. Yes.
I just wanted to ask, you mentioned asset allocation. Should we be rethinking that now for the next few years?
Absolutely. So thank you very much for the question. Asset allocation is something that we do consider, and it's something it's probably one of the most important decisions you can make as an investor. Leon and I are constantly discussing asset allocation, and we've made the appropriate steps leading into this. We'll show you later on what we have been doing with regards to that, and I will touch on that in about just a couple of minutes. But it's a perfect question for this webinar, and excellent, and we will discuss it. And thank you very much for that. Okay. Was there anyone else that had something to had any questions at this time?
I had a question.
Yep.
Chris?
Yep, we can hear you.
You talked about the rise in inflation, and the biggest item that I've seen is the price of fuel. Okay. Now, is that being manipulated, or is it just? I know the price of oil has not gone up. I mean, let's face it, the price of oil varies between $70 and $100 constantly. So I think it's around $80. Big deal. I mean, that's quite normal. Why has the price of oil or the product gone up? Is it just the taxes that we're all looking at?
And sorry, can you just qualify? Are you referring to the price of gasoline, or are you referring to the price of oil?
Price of gasoline
in Canada.
Which is I think having a big effect on the grocery stores.
No, fair enough.
Anybody that
Leon, did you want to address this one?
Sure. So great question, Barry. And even before you partially answered your question, I was going to answer with, so part one is taxes. And, we see it across the world. We see it more so in BC and particularly in Vancouver. And it's interesting, when we talk about inflation, the government says they want to, try to bring inflation down, but yet, and I get it's under a different category. The idea is carbon taxation, discourage carbon usage, but that is part of what is fueling inflation. When you look at even GST is collected at the end of the bill. The more the taxes that are layered on, it just compounds itself. So part of it is just plain taxation. The governments are taking a bigger piece of your wallet at the gas pump. Part of it is also geopolitics. So as you said, Barry, the price of oil is, $80, $90, $100 back and forth. It's been higher, it's been lower. But we're also seeing at different times, Russia has curbed diesel exports. So some, geopolitics there. Also some politics in that it's very difficult to build a new refinery or even expand a refinery. Again, I get why the move towards alternative energy, but some would argue perhaps things have happened too quickly, that there's been too much curbed on the production side, the ability to make gasoline, make diesel when there's not enough alternative fuel, make it up. So a big part of it is just supply and taxation is a big part of it.
Okay, now you just saw on the weekend, Prime Minister of the UK pulled back on the change of cars. I think it was 2030 or 2035 they were going for, and he just said it's not possible. And he's changing the whole game over there.
Yeah, and that could be almost another webinar in itself. One of the problems is, or part of the situation is, even with the use of electric vehicles, the use of in electric vehicles, let's call it in the Western world, overall usage of fuel, places like China, India, people have never owned a car before are now. Some of them are buying an electric vehicle, but some of them are buying a gas-consuming vehicle. So it is a very difficult target to try to keep up with new demand, as well as to basically take on the existing demand with the alternative energies. And it's been difficult. And then on top of that, the war, less output out of Russia, that sort of thing. It's been difficult, and we've had to see some rollbacks. And even I want to be careful, it's a politically delicate situation, but even within Canada, we have our targets for carbon emissions and that sort of thing. And everybody wants a greener planet. Absolutely everybody does. But it is tougher when we hear the immigration targets have gone from 250,000 to 500,000 that turned out to be 1 million. It's a lot when we're bringing in that many people, even if they're using a bus, that's more buses, it makes it harder. So it just is hard to, make that change that quickly. And we may see more, more rollbacks in terms of timing.
Interesting. Okay, thank you. Yeah, go ahead, Christopher.
Anybody else have anything to say or some questions? Okay, I think we're good. All right, so here's some key themes that we're seeing right now. We believe the US economy is going to be stronger than the Canadian economy going forward over the next couple of years. Clearly, inflation is still not under control, so we expect interest rate volatility to remain high. I would just remind everyone that interest rates are the tool that investors use to value all financial assets. So that means we expect volatility for all financial assets to remain high. So we expect valuations will regress back towards the long-term averages. As we saw, things are a little bit too expensive currently, and so we expect that to regress back. Most importantly, we believe that this environment favors individual stock picking versus index investing. So why we believe the US economy is going to outperform the Canadian economy? Well, to begin with, the Canadian economy is going to be much more sensitive to interest rates, higher interest rates in the US. The reason for that is that in the US, when interest rates were very low, they were able to lock into 30-year rates at 3.5% or lower. This compares to 7.12% today. So imagine being able to lock in and keeping your mortgage payments low for the duration of your mortgage. Unfortunately, we don't have that in Canada. In Canada, most fixed term rates only last for about 5 years. So for fixed rate mortgages, the renewal rates are double and sometimes even triple in some cases. Also, new mortgages are subject to the stress test. Now, this stress test essentially was set by OSFI to help prevent a housing collapse, which means that whatever you negotiate a rate with the bank is, they add 2% and see if you still qualify. So currently, this stress test, the rates for the stress test is between 8 and 9% currently, which is very restrictive. So, bearing all this in mind, what are we doing? From an asset allocation standpoint, we're overweight cash and bonds and underweight stocks. With bonds, sticking with high quality bonds with short and medium term durations. If rates go up, we plan on extending duration in buying bonds with longer maturity dates. For stocks, we are shifting some of our Canadian stock weighting towards US. We're sticking with best of breed companies that have pricing power. And the reason why pricing power is important is because it protects against inflation. We're making sure that the companies that we select have strong balance sheets, meaning that they can compete and be profitable in an environment where the borrowing rates are 5 and 6%. We want to stick with exceptional management teams and companies that pay not just a dividend, but have a history of dividend growth. Again, this leads to inflation protection. We want to focus on companies that benefit from secular trends or are recession-proof. And what I mean by that is, regardless of a recession or not, we want to stick with companies that can grow their earnings, that are benefiting from key trends in the world, like whether or not it's digital payments or the move towards cloud. These trends will continue to progress regardless of a recession or not. And we want to stick with the companies that will benefit from that. And finally, we want companies with strong competitive advantages, with defendable moats, economies of scale, or think those that operate in monopolistic or oligopolistic industries like the rails, credit cards, or internet search. Those types of industries tend to lend themselves very well to companies that provide companies with pricing power, which again is another word for inflation protection. So that's it for most of the slide deck on the economy. Hopefully, in terms of our actions, that kind of addressed what we're doing from an asset allocation standpoint. We have long been overweight cash and bonds, underweight stocks for this exact reason. And so we feel that we're well positioned. While we might not have a lot of, like Leon said at the beginning, we still have to wait and see where things go. There's a lot of moving parts, and I don't think anyone truly knows yet where things are going, but we feel that we're very comfortable with how we're positioned. I have a hand raised. We have a couple questions.
Perfect. So I think Chris was the first one with his hand up. If you want to go ahead, please, Chris.
Oh, thanks, Leon. Thanks, Chris. Yeah, I've got a quick question. Actually, a double question. There are talks about something else, which is the possible issues with the Chinese economy, whether it's real estate or whether it's stock market, and also the U.S. Real estate market, commercial, but maybe also residential. Can this have a direct or indirect impact on our investments? And if it does have an impact, what are the ways to mitigate that impact?
Yeah, excellent question. So that was a two-parter. Let's start with China. So China's economy, everyone did expect that their economy would rebound similar to the US and the rest of the world once they came out of lockdown. One thing that was very interesting to note is during the pandemic, the Chinese government did not supply the same fiscal stimulus as the Western countries did. So they were locked in, shut out for longer, but did not receive the financial support. So they were a little bit more in dire straits. Coming out, what's happening is that they have come out of lockdown, but their economy is struggling to gain traction. We are starting to see things pick up. It hasn't happened as quickly as some people have expected, but again, it's a little bit too soon to say that it's not coming back fully. Things are happening. We have seen some data points suggesting that their economy is reaccelerating. The last that I saw, their economy was supposed to grow at about 6% this year, which is kind of in line with the historic averages, but well short of what the Western countries printed coming out of the pandemic. So if you remember, we penciled in 12% GDP growth coming out of the pandemic in Canada. So to have China at 6% is disappointing, but things are starting to come back there. From an investment standpoint, obviously, those companies that operate there will experience a bit of slowdown in terms of their exposure there because the growth isn't happening. And sorry, what was the second part? Was with regards to real estate?
Yeah. Well,
pardon me. Sorry, Chris, U.S. real estate. But just before we move on from China, one piece I want to touch on really quickly. We have a number of concerns there beyond the economic slowdown, potentially, conflict with Taiwan. There's a number of pieces there. So there's thousands of companies that you can own, and we are generally avoiding direct or heavy exposure to China. There's companies like Taiwan Semiconductor. It's a fantastic company. We looked at adding it last fall when the chip makers were down. We avoided it because Taiwan and China, they're obviously heavily connected. Texas Instruments is another company that's been exhibiting great growth, but it is one of the U.S. companies most dependent. So we are being very careful with our exposure to China. We always look at, one of the things we look at is making money. One of the other things we always look at is not losing money. and risk. And again, there's a lot of companies we can buy. There's definitely some red flags involved with China, so we're light on that area. And I'm going to turn it back to Chris to address the questions on U.S. real estate, commercial, and residential. Chris.
All right, thank you, Leon. Yeah, so with regards to real estate in the U.S., the residential, it's really interesting what's happening there. As we discussed, people have locked in their mortgages, 30-year terms at on average 3.5% or below. So what that means is that even though interest rates are high, their mortgages are still low and they're locked in there for the life of the mortgage. So they're not really impacted financially right now. What does happen is that the incentive to sell your house and get a new mortgage at 7%, that's not happening. So what's happening in the US is that no one's really listing their houses. Now, we've kind of saw that in Canada, in Vancouver and Canada as well. But the difference is that in Canada, as we discussed, 5-year fixed rate mortgages are always, every 5 years, you have 20% of the market that's coming back and renegotiating a mortgage at a higher rate now. So you're still seeing some inventory from the sell side come back in Canada, but in the US, it's not there. So all of the action in the US now is the home builders, those people that are building homes from scratch. And but what we are seeing is that the impact from higher rates are starting to impact that area as well. On the commercial real estate side, that was the first area where people were starting to really panic and worry. Right now, we haven't seen anything break yet on that front. Again, it's a little bit too early to say. I will say this, though, if there are some casualties in that space, the amount of leverage that is being used this time around is a fraction of what we saw in 2008, 2009. So in 2008, 2009, you had leverage upon leverage that brought the system down. In this case, it's just one layer. Some people are borrowing too much. They can't make the payments. They need to default. They take their pain. The bank absorbs the losses, and away we go. I would also point out, this ties into the original question with China as well. We are seeing a couple of issues in China that are a little bit worrisome. And one of them is that we're seeing some short-term trends with regards to their housing market kind of coincide with their long-term demographic trends, where they've built too many homes and that their population is aging. They don't have enough people to fill them. So these two things are starting to kind of pull together in the same line. I'm more concerned with their real estate market than I am with the US. But then again, that's contained within China. We don't think we'll be affected by that too much because the banking systems aren't aligned, and they're pretty much a closed system there. The saving grace for China is that they're sitting upon trillions of reserves. All they need to do is bail it out. It won't be nice, won't be pretty, but they do have the capacity to bail out their economy. We still have some other questions. I see one from David, your hand's still up.
Yeah, first of all, Leon and Chris, thank you for taking the time to speak with us. Really appreciate it. I have two questions. One is around a statement you made, Chris, about in this environment of volatility, preferring individual stock to indexes. And that's a curious one to me. I wonder if you can say a little bit more about it, because one of the things I think we're seeing in the market is a lot of sensitivity of investors to very small changes in companies and sheets, and so that creates a lot of exposure on individual stocks, whereas in certain indexes, I think this year have been quite strong. So that's my first question, just around volatility. My second one is around how you think about the difference between stock price and dividend yield. And I think we've seen in a couple of sectors, especially utilities, where stock prices have gone down quite substantially, but people hang in there because of the dividend. So just wondering how you think about that issue as well.
Yeah, great question. Thank you very much. So let's go first with stocks versus using indexes. So indexes typically hold the good, bad, and the ugly. Okay, so what we like to do is isolate the stocks that will typically perform the best during a certain moment in time. So what we typically have is a business cycle, and different sectors will behave differently depending on where we are in that business cycle. And so, for example, when we are early in an economic expansion, that's the time to take risks. So you typically load up on more cyclicals, tech companies, stuff like that. When the economy is rolling over, you want to avoid the discretionary spending. Anything that is overly cyclical, so by being a little bit more active, you can underweight the areas that have the most risk. One thing that, for me specifically, I love the markets. I love to study the markets, and so that means I love to study other investors. I was listening to a podcast with Jeremy Grantham. He is someone that it's worth listening to for everybody if you're interested. One thing that he noted, and I thought was very telling, is that the only free lunch we have as investors is the quality of the companies we pick. So for the most part, most companies, they trade off of earnings ratios or whatever, and that the actual quality of the company doesn't command that much of a premium. And he said that's probably one of the only free lunches we get as investors. Well, I think that quality premium, I like to take advantage of that. And so if we can pick companies that are going to be less sensitive to economic slowdowns, then that's something that, or if we can invest in companies that will benefit based on the economic conditions, we like to do that. Now, in terms of the diversification and volatility piece, the CFA Institute, as well as almost any portfolio theory, will tell you that to achieve the same diversification as an index, you can achieve 80% of that diversification by using 18 stock positions. As you move higher towards 32 positions, you pretty much have 98% diversification of an index. So you can still diversify and reduce the volatility of your portfolio through diversification with just 32 names. And so if we can eliminate the poor performing names that's going to operate in a cycle, that's what we would like to do. Leon, you have something to add to that?
I do. So the other piece with, as you mentioned, Chris, buying the highest quality, and Jeremy Grantham kind of alluded to that as well. The other piece that avoids is it helps mitigate risk. So if you look at, for example, whether it be, a company in the gold sector, Franco-Nevada, mining is notoriously a perilous area. And when you go with the best in class companies, first of all, you avoid companies that have high levels of debt. That alone, in an environment of rising rates, you've eliminated a significant amount of risk. And it actually helps the stronger companies even more, because as interest rates rise, the companies with the higher debt loads have higher costs, and you tend to see some of them go bankrupt. So we can never look and say, okay, it's 100% certain guaranteed that beyond a GIC that this company is going to exist and is going to do well. We can never guarantee that beyond a GIC. But when we look at our companies, we can say these are the best in class companies. They are going to be the company that survives in this area. And as I say, by that nature, some of these corrections are actually healthy. As some of these other companies fail, our top in class companies actually do better. So that's another reason, the higher quality is a built-in defensive measure as well.
Does that help to answer your question, David?
Yeah, for sure. I do think, though, still there's vulnerability, right? And those picks. I think Algonquin is a good example, from last year, where people thought it was a pretty solid company, and then it started to be revealed that the debt level was too high, and they made some bad decisions, and that stock tanked quite substantially, right? So that was my comment is, in this, the psychology of the market is quite volatile, and even solid companies can be punished for missteps.
Yeah, so there is a reason why, as Chris said, we own typically around 30 companies, is because different things can happen. And that is, one of the reasons we're diversified. And as Chris said, with around 30 companies, we basically have, very strong diversification, very high level of security. The interesting thing as well, when you mentioned, the utilities. So first, and you mentioned dividends. So dividends are the core, or should be the core of any portfolio. Hard stop. When we delineate beyond that, what we really want to see is companies that are increasing their dividends. And that's particularly important today. And it's actually somewhat hard to find in Canada today. And one of the reasons I say that the dividend increases is so important is that as interest rates have gone up, there's been a shift in the way they're valued. And what I mean by that is 2 years ago, interest rates were 0% on the overnight rate, 2% on GICs, 2% on longer term bonds. And you would say, why would I put my money into a GIC with XYZ Canadian Bank when the stock is paying 4% dividend yield? I'm getting paid twice as much dividend to own the stock as I am to own the GIC or the bond. Why would I put my money in the bond? Today, and I didn't mean to bring up Canadian banks, but it's kind of good that I did. Today, when we've seen interest rates go up and we have some uncertainty into housing, you could argue it the other way. You could say, why would I put my money into the stock when I can get 5% guaranteed? So we have to be careful when we look purely at dividend paying stocks. Again, that's very important. But as Chris said, pricing power, highest quality companies, we have to be very careful that we're not caught in a trap of companies that are paying a dividend. And the best example of a company paying a dividend dying, and I'm not saying that's Canadian banks, but Yellow Pages was yielding 6, 8, 14, 20% as it went down and down and down. So we have to be careful and make sure that the company is prospering and doing well, as Chris mentioned also.
Diane, you had your hand up earlier. Did we manage to answer your question, or did you still have it lingering in your? Sorry, you're going to have to unmute yourself.
I'm sorry, technical challenge.
Not a problem. Go ahead.
It's okay. I answered.
Okay.
I mean, I don't have it anymore.
Okay. No worries. All right. Well, we did. If there's no more questions right now, we did have a couple of questions that people did send in before this that I'll just quickly go through. So let me just quickly throw this back up here. The first one had to do with the first home savings account, something that's introduced by the government. So just so you're aware, Canaccord is in the process. We should have these available sometime before year end. I've been told that they're working on it, and as soon as they are available, there are some clients that expressed interest. We'll reach out to you to let you know. But just to quickly walk through the pros and cons and the rules, these accounts are new accounts designed to help Canadians save for a down payment on their first home tax-free. And so the way it works, there's an $8,000 annual contribution limit that can be carried forward into the following year. So very similar to the TFSA and the RSP, there's a maximum that you can contribute. The lifetime contribution limit is $40,000. So you can just think if you're going to maximize your contribution of $8,000 every year, you can do that for 5 years until you've reached your lifetime contribution limit. So to qualify for a first home savings account, you need to be a first-time home buyer, Canadian resident, and between the age of majority and 71 years old. So in some provinces, that's going to be 18 years old, some 19 years old. What's really interesting is that you may transfer funds between your RSP to your first home savings account. And just say you have some left over after you buy a place, you can transfer it to your RSP or your RIF. But just make sure you don't do the transfers yourself. This needs to be a direct transfer to avoid any immediate tax consequences. And so what I want to make sure that it's very clear, if you are going to move money between your RSP to your first home savings account, you can't go and take money out of your RSP into your cash account and then move it to your first home savings account. That will actually trigger tax consequences. You need the institution like ourselves to make that move for you directly from one account to the other. So the limitations of the first home savings account is that, first of all, they can only be open for about a maximum of 15 years. So you have to actually close the account when one of the following occurs, and the first of them has to happen. Whether or not it's been open for 15 years, so you reach the 15-year anniversary, you turn 71, or you buy a place and you make your first qualifying withdrawal. So once one of these three thresholds are met, you have to close the account. So in terms of features, what's really interesting is that it kind of shares some of the features of an RSP and a tax-free savings account. But in a sense, it does capture the best of both worlds. So imagine that you're able to buy your own home using pre-tax dollars. You can now using this account. So we thought that's pretty interesting. Again, if you have, now we've had some questions about which one, once it becomes available, which one should we do specifically? Rather than get into that, that's very specific based on your circumstances, specifically income level, tax bracket, and what you expect to earn in the years forward. So, if you're looking to help out a child or a grandkid with that account, give us a call. We'll walk you through it. And again, we can give you advice based on your unique circumstances. Leon, did you have other questions that were sent in as well?
We do. Before I speak again, just going to again turn over any live questions from anyone.
Can you hear me? Okay.
I can, Barry.
The tax-free for the home, is $40,000 enough to qualify you?
Well, it obviously depends on what you're buying. What it allows you to do, though, allows you to take your before tax dollars, invest it, and all of that is tax-free, can be put towards a down payment. So I don't think they are thinking that it's going to cover all of it, but to make part of it tax-free,
okay.
that's their effort to help people out.
So it's not, you don't think it's not feasible in Vancouver?
No, no. It's and most of Canada, definitely not. And Vancouver, you could argue a bit how helpful that is, but it is better than nothing, I guess.
Oh, yeah.
But yeah, it's not. It's a small dollar value in a city like Vancouver for sure.
Ooh, boy. Okay, I have one more question, and this relates back to, I don't know if Chris will be old enough to know this, but you should be. Do you remember back in the 80s, interest rates are 18 to 20%? What caused that?
So actually, Chris is pointing to himself. So despite his age, he's going to pick that one up.
No,
yeah,
I worry about escalation.
Yeah. It's very interesting. Back in the 80s, you had a couple of dual forces that contributed to that. First of all, you had the baby boomers. The growth of the baby boomers entering and participating in the economy created tremendous demand for everything. At the same time, you had the oil embargo. And very similar to what we just experienced after the pandemic, where you had tremendous demand and supplies were constrained. And just as things were kind of calming down, you had the Russia invasion of Ukraine and the oil shocks, the potential oil problems that we had with Europe and oil spiking. That kind of tipped the scales off into the inflation of the 70s and 80s. The difference, though, is in the 70s and 80s, their understanding of macroeconomic forces, they weren't seeing data in real time like they can today. Well, not necessarily real time, but certainly with all of the technology today, you can really peek into the economy and really dive deep into at a very granular level. Whereas back in the 70s and 80s, you had to wait for data to get compiled, to come in, and they made the wrong decisions at the wrong times. And that really led to exacerbate the inflation levels until Paul Volcker stepped in and said, okay, I'm doing this no matter what it takes. And essentially you see interest rates rise to like 18%. Okay, so I would argue that it was a combination of forces, but what really led to the spike of inflation, like we were on our way earlier, But thankfully, the central banks in our time made the right choice in terms of, okay, if you have to raise interest rates, it's going to hurt, but they did it early. Whereas back in the 70s and 80s, I think if you recall, you had inflations running away in the late 80s, in the late 70s, but they didn't address it with interest rates until the 80s. So you almost had to wait about 6 years before central banks reacted to the inflation problems during that time.
Yes. Yes. No, I do remember that because I've always, I appreciate it. Good enough. Thank you very much, Chris.
Now, I was still very young when that happened, but based on my readings, that's what I picked up. Hopefully that matches your experience.
Yeah. Okay.
Thanks, Barry. Thanks, Barry. I'm just going to mention, we talk about home buying and all those things, tax-free savings account, first-time home savings account. The one thing I'm going to point out there is any of these, what we call wealth situations, life situations. My child is now 18, 19. They're starting to save some money. Where should we be putting that money? TFSA, RSP. Our younger investors, starting out, where should you be putting your money? We're thinking of helping our child buy a house. We're worried what happens if there's a marital breakdown, that sort of thing. Bring all those items up to us. And they're not necessarily our area of expertise, but we certainly have knowledge of those areas, and we certainly have connections with people in those areas. So bring those up. Feel free to call us, email us, and talk about your wealth situation, so to speak. I'm going to touch on one question that came in, and this one actually wasn't emailed in for the presentation. It was a question was asked a little while ago over the phone, and it was an interesting question that I thought it was a great question the client brought up. So I was talking to the client about what we're doing, the fact we're defensive, we're light on stocks, we have quite a bit of money in money market. And the client challenged me, and I would say correctly, he said, "You've always condoned market timing. You've said, it's impossible. Everything I've read says it can't be done. Yet it sounds to me like your market time." And it was a good comment. And so what I would say is we never try to time the market, but we have a very strict investment process. And there's criteria to buy, there's criteria to sell. There's many different indicators we look at. And one of the things we're seeing today is stocks are just plain expensive. And to put that in perspective, sorry. Okay, sorry, I thought there may have been a question there. To put that in perspective, in 2008, 2009, after the great financial crisis, I sat down over the winter holiday period into New Year's looking for stocks to buy, and our process identified hundreds and hundreds of stocks to buy. You could have bought anything, Microsoft, Procter & Gamble, any of it. And the problem was narrowing it down to, 10 to 30 select companies. Today, it's the opposite. So we're not consciously trying to time the market, but when we look at valuations, a lot of stocks today, our process identifies them as just plain being expensive. And then particularly when we look at the macro view that potentially we're in a period of a slowdown, may or may not, as Chris said, see a soft landing recession, but there certainly is a reasonable chance of recession. And the simple fact that, a couple of years ago, like I mentioned, the banks, interest rates were zero. We were willing to be a little more aggressive, paying higher valuations for stocks. Today, when we get paid, in the neighborhood of 5.5%, sit in overnight bank deposit notes to buy even short-term bonds, we're earning a decent return, 5.5%. We're not willing to push a string and overpay for stocks. So it's not a conscious market timing effort. It's just simply our valuations, our investment process is telling us stocks are expensive, and conversely, other areas are attractive. So Chris, I think you had a question as well you wanted to touch on?
Yeah, so prior to this meeting, someone asked us if we would just quickly give our thoughts about AI. Obviously, a lot's happened over there. It's been very interesting to follow that portion of the markets. So I'll just quickly throw this back up here. All right, so it's still very early days for artificial intelligence. Right now, besides NVIDIA, which I'm sure everyone's heard of, it's still too early to see how value will be captured in this industry. A good analogy would be like search engines. So if you remember back in the day, you had Yahoo, you had, this is even before Google. There's 4 or 5 different search engines, and all of them were running for free. Obviously, people had to do a lot of programming and whatnot into these search engines, but it wasn't until people started to monetize it through advertising that the value was ultimately captured. So with artificial intelligence, we think potentially it could have the same, follow the same path, where at the end of the day, the companies that produce them might end up having to give them away for free, and until they can find a way to monetize it, and that can take time. But a couple of things that are showing up right now that's clear is that developing AI solutions, the resources required are massive. So as an example, the thing that started everything off last November was ChatGPT, specifically ChatGPT-4. Now, this one program cost $100 million just to train. And that's based, that was based on an interview with Sam Altman, the CEO of OpenAI. And what he learned very quickly was that in order to produce and train these chatbots that are efficient and can actually work, it costs a multiple of what they thought it would originally, and they didn't have the money to develop it. Hence, they partnered with Microsoft. So in addition to the amount of money, it requires massive amounts of data to actually train your algorithm. And so the key players right now, as we see it, are Google and Microsoft. Google is actually the one company that developed the quote-unquote transformer. This piece of software was the backbone technology that enables all generative AI models. Essentially, the transformer it's a program that predicts the next word in a sentence. So if you put a string, a whole bunch of words together, it's this transformer model that makes a prediction in terms of what's the best word that should follow. And then once that's done, they use it again and again and again. So they're the pioneering company that developed this, and they made it open sourced. And so OpenAI took this and ran with it. But Google's clearly at one of the leading edges of this technology. You can see it in terms of their WAMU, which is their self-driving software, which developed. It's based very largely on AI as well. And again, Microsoft partnering with OpenAI, they're a leading force as well, and they plan on integrating AI into their Office suite of software products. Other companies in this space, Tesla, Meta, formerly Facebook, Adobe, they're all using it as well. But again, it's still unclear how they're going to monetize this, or who or what part of the industry is going to capture the value. So obviously, you recognize some of these names. We have exposure to some of them. But again, it's still early days in terms of how things will play out.
Okay, so I've got just one more question that was emailed in.
We're going to stop right there. We have a question from David.
Yeah, the whole space of AI, Chris, is really interesting, and I'm glad you touched on that. Can you just say a little bit more about the impact of the AI tools on the investment industry? And do you foresee, for example, AI-generated funds coming into the market as products? And how? So my question is really, how is AI transforming your business in the way that we will experience it?
Yeah, that's an excellent question. And that's actually something that I'm actively exploring as well, obviously being in the industry. From my perspective, our roles, there's a lot of different functions, from the basic administrative tasks to analyzing individual positions, to putting together an investment portfolio. And then even on top of that is integrating that investment portfolio with someone's financial plan and making sure that everything kind of pulls in the same direction. Right now, we expect that AI can help with the administrative functions in terms of opening accounts seamlessly, really quickly. And we expect that at that level there, a lot of efficiencies can be made. I have yet to see something that at a higher level is adequate for our industry yet. So in another example I'd use is a couple of law students used OpenAI to search for a case that they presented in court. So they used OpenAI to find a case that had the same precedent with the outcome that they were looking for, and they presented it in court. These two people got disbarred because that case never happened. Right? So obviously, there's still a lot of holes. It's very, very new. We're going to take our time with this. So even if you look at with Google or Apple or any of these tech giants that you see today, if you think back towards their infancy when Amazon was just selling books, right? We're still in very, very early innings. And it doesn't mean we're going to miss the value there, because as public companies, the majority of the value created in those companies happened well after they IPO'd. And so right now, just the way the dynamics work in terms of the resources that these companies require to develop these tools, from cost to also, you need a huge amount of data. Like the database that you require to train these things, not a lot of companies have. And so, thankfully, we're already positioned in what we think are, some of the lower risk leaders in that space. But in terms of the impact into our industry, we haven't seen anything besides the administrative functions so far. What I will say, though, is that the acceleration and the evolution of AI has happened a lot quicker than almost anyone has expected. So what's really interesting is that when they first started off with their training, the training of their algorithms, the results got exponentially better the more variables they used. So in terms of variables, we're talking about 1 billion variables originally. And even then it was very clunky. It wasn't until they exceeded 5 billion different variables that things start to make sense. And now they're training AI on 10 billion variables. So you think of the compute power and all that goes into it. You're seeing exponential growth in terms of the results. So who knows where, and again, we're still very, very early days, but it's going to be really expensive to produce, and it's going to be fun to follow.
The other piece I'm just going to touch on there, David, as well. So we always talk about risk management, and one of the things that I said long ago is we will never be guinea pigs. So as it relates to mutual funds, if we own a mutual fund with a proven manager, and we know that manager is the key, it's not a system, and that manager retires, moves to another company, whatever the case may be, we have always moved our money either with that manager or to another area. We will never be a guinea pig. I would far rather have us look back and say, oh, it turned out the new guy was okay, or he was even better. I'm fine with that outcome. What I'm not fine with is, a year or two later, oh my goodness, what happened? Why didn't we do? And it's the same with, potentially the same with AI. And there was a mutual fund, a bank that launched a mutual fund a number of years ago. And I'd be happy to give you the name afterwards. I just don't want to do it publicly because I'm going to mention, or I would be mentioning the name of bank and the name of the mutual fund. But the mutual fund, what it did is it analyzed past data, and then it basically made your investment decisions based on that, what historically had worked well in the past. And it did extremely well until 2008, 2009, and then it absolutely blew up. Clients lost a fortune because what happened was it was using valuation, and it was looking at, for instance, the European banks and saying, okay, this was $100. It's now $30. So there's good value there. But what it couldn't figure out was because of the subprime, blah, 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 that these companies were actually worthless. So it kept dumping money into these companies because it thought there was better and better value. And then there was a mutual fund company that launched a similar type product, had the same results. So we would be very, very, very careful before we even remotely considered, using that as a key part of our investment decisions. The other piece, or one more question I just want to touch on quickly, and I want to be cognizant of everyone's time, and I realize we're over an hour, so I want to be quick with this one. It's a question, though, that over the years, different people have asked different times, and it's a very good one. Basically, the client said, I'm not as concerned about inflation or in particular this moment. What I'm concerned about is government's record spending, record debts. At what point are people going to stop buying this? At what point are they no longer going to trust what he called sovereign, or basically debt issued by countries? When is that going to happen? And so there's a couple pieces there. First of all, and he mentioned, so first of all, unfortunately, it's a bit relative. And what I mean by that, we've seen heavy spending in Canada. Every time we turn around, there's a program to fix something. There's a program to do this, program to do that. Similar in the United States. We've seen heavy spending in UK, in Europe, Japan, all over the world. The reason that's important is because to a degree, sovereign debt is measured on a relative basis. So I brought up this example before. If you're Argentina and you've defaulted on your debt several times in the past, and it looks like you're going to default again, you're going to have to pay people a huge interest rate, a huge rate of return fee to take a chance on them. You're not going to lend money to the Argentinian government at 5%. Maybe if they're offering bonds 10, 15, 20, depending on your risk appetite, we're never going to buy them. Chris and I are never going to buy them. It's just, again, risk reward doesn't make sense, all or nothing. But some people at 15 or 20% may say, you know what, I'll take a chance with an Argentinian bond. Now, a bond issued by, for instance, the US, there's problems with US spending, as with every other country. We saw it with the potential debt ceiling in the spring. They are absolutely spending way too much money. Absolutely, they are. The debt is absolutely too high. And that's one of the reasons why people have said, despite the rise in short-term interest rates, longer-term interest rates, in other words, the 5, and in particular the 10-year, the 20-year, the 30-year, they have to remain low because governments simply cannot make the payments on the debt at higher levels. So when interest rates were near zero, of course, the governments could make the payments on the debt. As they're approaching 4, some people say 4.5%, which is where we're nearing. Some very strong strategists have said we start to reach a tipping point where there's just too much of tax money going into servicing the debt. So they need to have lower interest rates to function. And how they can do that, and the client asked about that. So yes, they absolutely can and would consider printing more money. It's a balance with inflation, but that is one way they can keep interest rates lower. The other thing is in terms of default and, for instance, not buying a US bond. As an alternative, where are you going to put your money? Chinese bond, most would say more risky. UK bond, Europe bond, many people would argue riskier. So by de facto, the US is going to continue to attract some of that money. The other thing at the end of the day, one of the reasons why government bonds are considered safe havens is they have the ability to tax basically unlimited amounts. They can tax you, they can tax corporations. If a corporation starts to become profitable and they need money, they can actually put extra taxes on a corporation. What is an example of that? This summer or this spring, not the Bank of Canada, our government, our prime minister said, without saying it, banks are profitable. We're not profitable. We're spending more money than we're earning. We're going to put a surtax on banks. So they did. They can put higher taxes on gasoline. They can increase your personal tax rates. So they have the ability, unfortunately, to continue to generate money. They have the ability to tax. But that is one of the reasons why we saw people putting money into crypto. That is one of the reasons why we see people put money into gold, is because of the worry of government spending. It is something they have to bring under control. They absolutely are all spending too much. So it is something they have to bring under control. At the same time, I also have to mention, ever since the financial crisis, 08, 09, we had a lot of news writers, particularly in the early years, saying, the world's going to come to an end. There's too much debt. This is not sustainable, all these different things. And I actually had clients phoning me or forwarding me articles. And I would say, okay, but what is actually happening? We are seeing more people getting a job. We are seeing people book hotels. We are seeing people in golf courses. We are seeing people buy televisions. We are seeing people spending money. And we can't forget that despite the fact governments are spending too much money today, one of the problems, the underlying problems, is that the economy in the US in particular, but Canada as well, has been too strong. We've had too many jobs. We've had too much wage demands. And that is a good problem to have. Having an economy that is too strong is far from the worst problem in the world. So there is no reason to expect that we would see an immediate implosion in this area. And we do expect things to continue functioning normally in that regard. So I think on that note, I think we'll wrap it up. I want to thank everybody for your questions. Great questions. I want to thank you for your time. And as always, any further questions, call us, email us. We're always available. Thanks so much, everyone.
Have a night, guys. Thank you very much for your time.
Thank you.